the main difference that it's really important to keep track of it between Canada and the U.S. Is the basis of the tax. In the U.S., it's a value-based tax, and so it's not really a sale or disposition model. Whereas in Canada, as Matt just said, it's a gain model. And the example we always give to clients is that somebody goes into a closing, buys a property, pays $1 million of cash, walks out of the closing, gets hit by a bus. There's no deemed disposition issue in Canada because the value obviously equals the basis. In the U.S., there's $1 million of taxable estate because it's a value question and not a gain question. Obviously, one of the things that we encounter and that we try to guide our clients through in the cross-border context is mismatches between Canada and the U.S. We're often able to, despite the difference in underlying factors generating the tax, we're often able to structure things so that the incidence of the tax will be the same. And ideally, that means the same in terms of time, imposed at the same time, and the same in terms of taxpayer, meaning that the same taxpayer is going to be considered to have the income in the U.S. and in Canada, and the same with respect to the different jurisdictions, so that if there are available credits, either under statutory law or the treaty, that those credits will be maximized. The rule of thumb that I like to follow is that it's fine for somebody who's a resident in Canada or a resident in the U.S. to hold tax favored assets based on the other side of the border, but it's probably not a good idea for them to take money out or put money into those assets. So for instance, it's going to be hard. And again, this rule of thumb really addresses the payment liability more than the reporting obligations. As we all know, the IRS has a whole stack of forms that it likes people to use to report all these things. But it's going to be pretty hard for a U.S. citizen to have a tax payment obligation with respect to retirement account in Canada, or on the other side for a Canadian to have obligations with respect to a retirement account held in the U.S. Obviously, it's possible, and I'm not talking about deduct. I mean, there's a whole bunch of qualifications here, but putting money in or taking money out is going to be complicated. And so I think that's where people get into trouble. There is protection under the treaty, but often it's really not worth it to have that kind of asset.